This class has been progressing very well. I understand some are just joining the online PM group. Some have just registered. On my part, we have treated the following topics. We have treated cost estimation. That was the first topic. Then we moved to price theory, pricing decision. Later, we looked at modern costing techniques. Under the modern costing techniques, we have treated life cycle costing. We have treated target costing. We have treated throughput accounting and the theory of constraint. Then last week, we treated activity-based costing. Technically, I have treated 6 topics. Why am I doing this recap? Is to let the new students who are joining currently to be done. You can always liaise with the coordinator. We have a particular director that is dedicated to these online classes. That was the number that was shared on the PM platform to get the previous classes video. All right, let's go to today's lecture proper. Divisional performance evaluation. The topic we are about to treat is looking at companies that operate on divisional structure. The topic we are looking at tonight is companies that are structured along divisional line. A good example is Dangote Group. If you look at Dangote Groups, we have Dangote Cements, a division under Dangote Group. We have Dangote Transport, a division under Dangote Group. We have and drinks. You have Dangote Sugar, Dangote Salt. Please. Anthony, please, can you mute? You are conflicting this class. Thank you. You can also look at John Oates PSC. John Oates Group. You have John Oates Yamaha. You have John Oates Ventures. You have John Oates Renters, a division under the John Oates Group. Now, the topic is, how do we evaluate divisional performance? Divisionalization involves the decentralization of decision-making powers. When we say divisional structure, this involves decentralization of decision-making powers to division. Hence, division achieves some degree of autonomy and freedom. A divisionalized company is one whose organization and operations are segmented into semi-autonomous units. With a large degree of responsibility for decision-making. Let me explain that. When you say divisional structure, or company being run on divisional structure, each division is given decision-making powers. Each division is regarded as a company on its own. Even though you operate within a group, each division can take their own decision. If you place your mind to Dangote, we have Dangote Cement. Dangote Cement has its own divisional manager. That is the managing director of Dangote Cement. That is the overall head of that division. That division has its own staff. They prepare their own accounts. If you take Dangote Sugar, you have divisional manager who is allowed to take independent decisions. Their concerns is division. That's what we refer to as a divisionalized company, a company that operates on divisional structure, whereby each division takes responsibility for its action. Now, the next question is, why is it important for us to carry out divisional performance? Imagine yourself as the finance director of Dangote Group. Imagine yourself as the finance director of Dangote Groups. Under Dangote Groups, you have different divisions. And each division will report their own profits. At the end of the financial year, why is to evaluate performance of each division? In other words, what is the objective of divisional performance evaluation? One is to ensure Go Congress. When we say Go Congress, you want to ensure that the objective of each division is in line with the objective of the group. There's just one company, Dangote Groups. Each division must work towards the objective of the parent company to ensure what? Congruence. Point number 2, to increase motivation of management. We have created division. And we want to measure performance. This will increase motivation. Whatever is not measured, then we cannot assess. There's no reason to work hard if your performance is not being measured. Divisional performance, motivation. Imagine you are the divisional manager and your performance is evaluated and you are rated very well. Because you are rated well, it will increase your motivation. Number 3, divisional structure reduces head office bureaucracy. Divisional structure reduces head office bureaucracy. Where a company is run under divisional structure, you don't need to wait for head office for your decision. Certain decisions can be taken by the divisional manager. Imagine Dangote Cement with factory in Benue State. The production is done in Benue State. Divisional manager is seated in Benue State, but the corporate head office is in Lagos. Such decision can be taken by the divisional manager at the location in Benue State. Point number 4, divisional structure provides a better training ground for you can train your middle level management staff at the division. And lastly, divisional structure improved strategic decision making. We wonder why Dangote is into many businesses. Some will ignorantly say that only Dangote, cement, salt, sugar, Dangote drinks, Dangote noodles, Dangote Maggi is a strategic decision-making team. The owner has diversified into different businesses. And each business is taken as an independent business unit. Those are the objectives or benefits of divisional structure. What are the limitations? 1, suboptimality. The major disadvantage of divisional structure. A major limitation of divisional structure is the potential for dysfunctional decision making. When we say suboptimality, it means where a division takes decision not in the best interest of the corporate head office. You know, it's very possible where a divisional manager, because head office cannot see what they do. Look at the illustration we gave. Dangote cement factory is in Benue State. The corporate head office is in Lagos. Divisional manager of Dangote Cement is seated in Benue State. The person that is not in the best interest of the corporate head office. That is what we call suboptimality. You are trying to pursue your own self-interest. Divisional manager tries to pursue his or her own self-interest, which may not be in the best interest of the corporate, of the company as a whole. Point number 2, increased cost. If you have company operating on divisional structure, it can increase the cost of the business. Some functions may be duplicated. Some common functions can be duplicated. For example, maybe Dangote Cement, they have their Dangote Cement as its own HR. That means that function is not duplicated. You have HR in Dangote Cement, you have in Dangote Salt, you have HR in Dangote Sugar, you have HR in Dangote Transport. That function has been duplicated. Cost will increase. Account departments. Each division wants to have their own account department. That function has been duplicated. Such function could be centrally controlled. Point number 3, loss of control. Where a company runs on divisional structure, the corporate head office may not have firm control. It's like having your branch in Kano and you are in head office. You cannot see what they are doing there. You are only relying on the information they are giving you in head office in Lagos. The corporate head office may lose control. Please note that. Now, because of this limitation, what are the limitations? Some of loss of control. The company must introduce a suitable system of performance evaluation. Let me repeat that point. To address some of these problems, company must introduce a suitable system of performance evaluation. Address or that we have the following objective. Performance evaluation must promote goal congruence. Any performance evaluation we are using must ensure that the objective of the division is in line with the objective of the corporate head office. Please note that. Let me quickly say that last diet, 2 questions was taken from this topic. It was surprising. Last diet, 30 marks question was taken from here. Question number 6, question number 7. So, performance evaluation is to promote goal congruence. Number 2, performance evaluation must encourage initiative. It must not discourage motivation. Any performance evaluation you are giving, because we must see ourselves. Imagine yourself as the chief accountant and you have to suggest performance evaluation for your company. You must ask yourself, any performance evaluation I'm suggesting to the management must promote goal congruence. It must not discourage motivation. It must encourage initiative. You must allow individuals to think and bring suggestion. Let them take decision. Point number 3, the performance evaluation system must provide feedback to management. And lastly, the performance evaluation must look at long-term benefits, not short-term. In other words, we are not only talking of profit performance. Imagine the number of years First Bank has been existing. Imagine the number of years John Oates has been existing. Look at Nestle Food. Your performance evaluation must mirror long-term view. Now, to achieve the objective highlighted above, company must introduce responsibility centers. Please note also, this topic we are discussing have a lot of relationship or has a lot of relationship with the next topic, transfer pricing. Why am I making these points? When we get to the next topic, transfer pricing, the knowledge you gathered here is also required for transfer pricing. All right. The objective we have explained above can only be achieved where there is responsibility centers. We have responsibility center, we have responsibility accounting. We are going to define the two and bring out the difference. Responsibility accounting. In a responsibility accounting, a specific manager is given the responsibility for a particular aspect of the business. When we say responsibility accounting, an individual is given a specific task, and that individual will be liable for that tax. I will repeat that. Responsibility accounting, a specific individual, a manager, a director, is given the responsibility for a particular aspect of the company's budget. Company, we have budgets. Company will draw up budget showing their plan and the money to be used. Just like a country, the country must draw a budget that shows the and how the plan will be financed. Same apply to company. Just 1 minute. Let's continue. So in responsibility accounting, a specific manager is given the responsibility for a particular aspect of the budget. And within the budgetary control system, he or she is then made accountable for that actual performance. If you look at typical company, you have head of accounts. Head of accounts, that head of accounts is a responsibility accounting. That person heading account take responsibility for all the action of accounts. Head of HR, so that if anything happens, we can know who to hold responsible. Head of HR, your duty is to quality, quantity, If you cannot give us quality staff, that becomes the failure of head of HR, production head. An individual is made responsible for a particular aspect of the work. That is responsibility accounting. Why a responsibility center? A responsibility center is a department or organizational function whose performance is the direct responsibility of a specific manager. If I say production department, that department is a responsibility center to handle production. Now, the production manager is taking as the responsibility accountant now. The man that takes responsibility for production department. I hope that point is well taken. This was tested last diet. Responsibility centers, basically we have 3. Although I can study park, 4 was documented, but basically we have 3. The last 4, number 4, we only come in government, not in company. One is the cost center. Responsibility center types. 1, cost center. It's a department or section or function over which a designated individual has responsibility for expenditure. A cost center is a department or a section or a function over which a designated individual has responsibility for expenditure. When we say a cost center, that department only incur cost. They will not generate revenue. That department will only incur cost. Technically, cost center can be defined as a production or service location, function, activity, department, or item of equipment for which costs are accumulated. A good example is admin department. For most organizations, admin departments is only to spend money. The admin department, they are in charge of purchases. Maybe purchase of store items, purchase of raw material, purchase of motor cars, purchase of diesel. They only spend money. Please note, a division cannot be a cost center. Please note a division can never be a cost center. Number 2, profit center. It's a segment of business entity by which both revenue and expenditure are controlled. When we say profit center, it could be a department, a business unit, a section. That department or that business unit can generate revenue. They can also incur costs. The difference between the revenue and the cost incurred represents profit of that segment. That department or business unit is allowed to generate revenue and to incur costs. They can now determine their profits. The manager in a profit center is held accountable for the profitability center. The manager can incur costs. The manager is also responsible, is also expected to generate revenue. Please note, a division may be a profit center. A division may be a profit center. Division can incur costs. Division can generate revenue. Then we can determine divisional profits. Number 3, investment center. An investment center is an advancement, a step ahead of profit center. An investment center is a step ahead of the profit center. The investment center is allowed to generate revenue, to incur costs. At the same time, is allowed to make investments in fixed assets. The investment center can acquire non-current assets on its own. A profit center can only generate revenue and cost. But the investment center, in addition to generating revenue and cost, it can calculate its profits. The investment center is allowed to make investments in fixed assets. A division can be an investment center. A division can be categorized as an investment center, where divisional manager is allowed to make investments. He can take money, he can utilize divisional money to make investment in assets. We can now relate the profit achieved to investments. That is return on investment. we can relate the profit achieved to the investments made by the investment center. Please note, a division can be an investment center, but a division can never be a cost center. I hope that point is well taken. Lastly, the revenue center. This is not common in typical companies, but you have it in ICANN Park. So let's discuss it. Most textbooks I've seen, they're always listing three. When we say revenue center, it's a department or a division. It can never be a division. It could be a department. It could be a unit that is established only to generate revenue. They only collect revenue. They cannot even spend the money. In a revenue center, there is no measurement of cost or profits. The revenue center manager, we only need information relating to the revenue. It's only meant to collect revenue. Like if you look at the bursary departments, when you go to pay your school fees, those days when the university, you just pay bursary. You just pay your school fee. They will collect school fees from you. That is revenue center. They are only meant to collect that money. They cannot spend the money. So please note it. Okay. Management. Okay, let me not omit this, although it's not. Let's look at this. Let's not overlook it, although it's not too. Defining information need of cost, revenue, profit, and investment center. Of course, for a cost center, they will only keep expenditure under control. If you look at admin department will be expected to keep costs under control. Don't spend too much money. Ensure you are keeping the company cost under control. For revenue center, they must ensure that sufficient amount of revenue is collected. They must ensure that all revenue sources are identified and they collect the money. For profit center, you want to ensure that you make sufficient profit for your division. Then for investment center, that must ensure that a suitable return on investment is achieved. Management accounting problems. When you have division, some problems where a company is run under divisional structure, some problems are likely to come up. Where you have intercompany transaction, where Division A renders services to Division B. What is the price we are going to use? Imagine imagine John Oates Yamaha. John Oates Yamaha is into generator sales and maintenance. John Oates Yamaha sells generator to the public, to external customer. Now, if John Oates Yamaha is selling generator to John Oates Ventures, at what price will that transaction be consummated? Please asterisk this point. That is the next topic. Transfer price. Number 2 problem, apportionment of overhead costs. Common costs incurred on behalf of all divisions. For example, maybe the HR is centrally controlled. The HR is responsible to source staff for Division 1, Division 2, Division 3, Division 4. Now, HR has incurred costs. How would this cost be shared to the different divisions? We'll get to that. The management accountants will ensure that the apportionment is as equitable as possible. Next, financial performance measure. Divisional performance can be done using financial measures. Under the financial measures, we have return on investment. Return on investment relates profits achieved to the capital employed. We can use return on investment to measure divisional performance, calculated as operating profit divided by the capital employed, multiplied by 100. We can use return on investment to assess divisional performance. Please note, this method can be used in appraising divisional manager performance and the performance of the division. Now, there are two things. Division is an entity now. You can now assess division's performance. You can also assess the individual manager's performance. To do this, we must make decision between controllable profits and traceable profits. If you are to assess divisional manager performance, you are going to use controllable profits. Profits within the control of the divisional manager. divided by the investments within the control of the divisional manager. For example, if a loan is obtained by the division and interest rate applies on that loan, that interest rate is not within the control of the manager. The rate is externally determined. That's what we call controllability concept and non-controllability concept. Controllable cost, cost within the control of the manager. If you are going to assess my performance as a manager now, my performance on those variables within my control. Taxation is not within the control of the manager. It is government that determines the tax rates. That's what we call controllable profits. This is a profit derived by the manager after taking care of all costs under his control. We have traceable profits. This is the profit derived by a division after taking care of all costs that can be traced to that division, whether within the control of the manager or not. Your division has taken loan and there is interest cost. That cost can be traced to your division. Cost incurred by head office will not come here. If head office incur cost and part of the cost is apportioned to division, that cost is not incurred by the division. It was an overhead cost incurred. Head office now apportioned to all divisions. It should be noted, all controllable costs are traceable, but not all traceable costs are controllable by manager. So please note, if you are to calculate performance of a divisional manager using return on investment, you are going to use controllable profits divided by divisional capital employed multiplied by 100. If you are to evaluate the performance of the division now, then you are going to use traceable profits divided by divisional capital employed multiplied by 100. And please note, your capital employed is the sum of non-current assets plus the working capital. Your capital employed, for simplicity, is all individuals, or better still, all finance that shareholders' funds plus amounts contributed by the debt holder. That is capital employed. But it's also correct. Your non-current assets, plus current assets minus current liability. That is the capital employed. Is it correct? So you can use return on investment to assess divisional performance. You can also use residual income method. What is residual income? Is simply profit, the operating profit less notional interest, or what we call imputed charges, imputed interest. The concept of residual income is that a division can only be assumed to be profitable if you are able to generate sufficient profit in excess of returns to the providers of capital. A company can a division can only be assumed to be performing well if that division can generate sufficient profit in excess of returns required by the providers of capital. That returns required by the providers of capital is what we call interest charges or notional charges. How do we compute this? If you are to examine divisional manager performance, you are going to take the controllable profit minus notional interest on controllable investment. To compute this, you are going to take the cost of capital multiplied by the capital employed. Look at it here. It's even here. The imputed interest is the return given to the suppliers of funds and is computed by applying cost of capital to the division net investment. That is your capital employed. Just calculate the cost of capital multiplied by capital employed. That will give you imputed interest charges. You now less this from operating profits. If the figure is positive, it implies division is. If that figure is negative, it implies the company's division is not doing financially well. For divisional performance, identify the traceable profits minus the imputed interest charges. All right, any question?
Sir, the cost of capital, is it always on percentage? Is it the same thing as weighted average WACC? Is it the same thing with it? Are they the same?
Okay, yes. Okay, yeah. Cost of capital is also WACC. Okay, this is PM class. We also call it WACC.
Okay, sir. Thank you, sir.
And it's also called WACC. If you get to, let me explain it briefly. And that's what I say. When we say cost of capital, we also call it weighted average cost of capital. If the company is, usually a company is financed by equity and debt, then that company has gotten two types of finance. We now look for the weighted average of the equity and debt to compute our work. So for simplicity, you can call it cost of capital or the weighted average cost of capital. When you get to finance, by God's grace will meet, then you are going to do work fully. All right, let's review questions. It's not when I was taking them, I was like, this is not, it's not a major area that you can relate with it easily. But again, they got past us. It's got that pass. When I was looking at, let's go to this illustration one. Let me leave story for now. Maybe when we're about to close. Illustration one. Omagbeoje and Co. Or you see Omagbeoje and Co. It's a medium scale outfit that specializes in rental in Owerri and Isekenesi town. The company has a gigantic event centers in each of the two cities. The rental business is tailored to supply chairs, tables, canopies, outdoor event center, and in some cases to indoor event center owned by the company. Just 1 minute. Just want to take water. Let's go on. Each event center is managed by a manager who is given some level of independence in the management of the affair of the center. Event center managers and their staff are rewarded with performance bonus of 10% of sales if they earn more than the approved standard return on capital employed, which is 50%. Please note that the standard return that management has approved is that a division must achieve 50% return on capital employed. That is 50% return on investment. The following information is extracted from the accounts of the company as it relates to the centers. Yes, ended 31st March 2020 and 2019. You have the information given. Owerri Center, Isekenisi Event Center. You have the information supplied to us so long. Please, I like to have them together. I don't like this breaking. We have the revenue, rental and hire services, salaries, consumable, other operating costs, total non-current asset less depreciation, total current asset less cash and bank, long-term debt, current liability, interest expense. Further information. Revenue is derived from rentals and other auxiliary services to customers. Both centers have a cost of capital of 15. Ignore taxation and inflation. Required A. Discuss the relative performance of the two centers using the following basis: return on capital employed, residual income model, profit margin, current ratio, quick ratio, gearing ratio, interest cover ratio. Now look at this. We want to use financial ratios to assess the performance of two centers, two divisions, one in Owerri, the other in Isekunisi. Examiner now says use return on capital employed. You cannot put down the formula. Your return on capital employed, you can put the formula. It's also return on investment. Your operating profit, That is profit before interest and tax divided by capital employed. Your profit, please, you can put down the formula in your book. For Roman figure 1, you can put the profit. Or we can now go and get, what do we require first? We need to get capital employed. What is your capital employed now? Your total assets less current liability. It's in your book also. Even though solution is provided here, I want to calculate return on capital employed. The formula is profit before interest and tax divided by capital employed. Profit before interest and tax divided by the capital employed multiplied by 100 over 1, where capital employed is equal to non-current assets plus current assets minus current liabilities. Now let's go to it. If possible, open solution in your book. Let us take the figure. I'll come here. Total non-current asset, less depreciation. Pick this figure. Total current assets, less cash and bank. Pick these figures. Cash is part of our asset. Pick this figure. These 3 figures will give you total assets plus non-current assets. The 3 highlighted rows will give you the total asset of the business. Please look at it. Total non-current assets, current asset less bank and cash, then bank and cash. You can add up. Please, let's do our addition. Please sum up. For Owerri 2020, get your total assets. If you are doing it at home, confirm it. For Owerri 2019, get your total assets. For Sekenesi Event Center 2020, get your total assets. Sum up. For Sekenesi 2019, get your total assets. Please, let's confirm these figures.
For Owerri 2020, 8,700.
We can confirm all. It's also good if you are working it at home. When you have it, then pick the figure for current liabilities. Just carry the figure. Look at it here. This is distraction. It's not supposed to be here. Copy your figure. Come and less for here. With the dots. It's chatting me. Please, let's confirm it. Yeah, where is Pascal self? That's the truth. Samuel is even here too. Let's speak now. We should not even be solving it. We come and solve in class.
So I'm with you.
Yeah. Please confirm you have gotten the capital employed.
Yeah, confirm. All figures correct.
Okay, you have
Confirm.
gotten the capital employed.
Yes.
You can now come to calculate your profit before interest and tax. Profit before interest and tax. Take your revenue. Yeah, let's go. We are going to do this together now. Yeah, revenue. We are open. Revenue. Look at it. 10,400, 9,600, 10,000, 6,000. Yeah. Pick your revenue. Less operating costs. Rental and hire service operating costs. Salaries and wages operating costs. Consumables operating costs. Other operating costs. Please. Revenue less the 4 operating costs. What is our profit before interest and tax for each center and for the years under consideration?
3,300.
Okay, for the first one, you have 3,300.
3,300.
Good. That was 2020. Please allow me. I like to move them together. I don't like having the. I think be on the same page.
Huh? Not back. He's back. He just got your number. See your brother. Thank you. You know by one thing.
Who is completing the class now?
Oh, sorry. Hold on. Tó bá ti ra oúnjẹ ìbúlẹ̀ fún mi.
Oúnjẹ báwo?
Hey, Jesus.
2019, 3,470.
3,470. Get the operating profits. That should give you 3,070. in 2020, 2019, 2,640. Have you confirmed that, please? You can now come to the ratio now. Return on capital employed.
Sir, this
Operating.
one is
Sir, the 2020.
3,970. 3,970.
Oh, this is wrong, Abby.
Yes.
Yes, 2020 for CKNSC.
9 what?
3,970.
Oh, buddy. Okay, let's see how it goes. Now, the profits divided by capital employed. 3,300 divided by 7,600 multiplied by 100. What do we have? Oh, yeah. Operating profits divided by capital employed. Your final answer multiplied by 100.
43.4.
You can change it to percentage. 43.4%. Next, operating profit 3,470 divided by capital employed 7,200 multiplied by 100. What do you have?
48.2%.
48.2%. Next, 3,970 divided by 7,200. What do you have?
55.1%.
55.1. Next, 2,640 divided by 7,440.
35.5%.
35.5%. I've just converted to percentage. Not that it's wrong. Oh. You have answered A Roma figure 1. A Roma residual income. Residual income is operating profit minus what? Imputed interest charges. Please define it in your book, calculation-wise. Residual income, please define it in your book, calculation-wise. Your residual income is operating profits minus imputed interest charges. Note, imputed interest charges is equal to cost of capital multiplied by capital employed. We can go to it now. Pick the figure. Operating profit, just copy it. our operating profit. Just copy it from here. 3,300, 4,000, 4,750, 7,447, 3,970, 2,640. Imputed charges, 15% of capital employed. Now, please come here. 15% of 7,600. Please compute.
1,140.
Good. Next, 15% of 7,200.
1,080.
You have it here. Next, 15% of 7,440.
1,116.
You can get your residual income now. Profit minus imputed cost or charges. 3,300 minus 1,140. Please confirm for the whole centers. Please confirm. Where is the document? Just
Confirmed, sir. Everything is correct.
Hello.
confirm correct, right? We have resolved the residual income. That means we have settled A Roman figure 2. A Roman figure 3, profit margin. What is profit margin? Operating your revenue. Your operating profit divided by your revenue. You can note it. Yes, Sam.
Sir, my question is, these consumables, is consumables an inventory?
Okay,
Or
consumables.
yes.
Consumables, they are items used in the office now, like your provisions. Some company will give Lipton, teas. They form part of your consumables. Your toiletries. Do you understand? Like
Yes, sir.
admin now, they will buy tissue paper. We call it consumables. Do you understand it? For the event center now, they definitely they will have restroom. They have convenience room. If you go there, you expect to see tissue paper, you expect to see the hand wash soap. They form consumables. Is that clear, sir?
Yes, sir. Yes, sir.
Those are material consumed, really. It's part of the cost. Now, your profit margin. Your profit margin, you can note it, even though we expect that most of us will know it. Profit divided by your revenue, that is your sales revenue, multiplied by 100 over 1. Your profit margin is profit divided by sales revenue multiplied by 100 over 1. You can pick your figures now. We have calculated operating profits. We have revenue. What next? What next now? Look at it now. Operating profit in under Owerri 2020, 3,300. Revenue 10,400. Please divide 3,300 divided by 10,400 multiplied by 100 over 1. What do you have?
31.7%.
I can change to percentage now. 31.7%. Still under Owerri 2019. Operating profit 3,470. Revenue 900. What do you have? Multiply by 100.
What 36.1%.
36.1 or 0.2?
6.1, sir. 36.14.
1.4, Abi?
Yes, sir.
Now we move to the next center, Sekenisi Center. Operating profit 3,970. Revenue 10,000.
39.7.
39.7. Then 2019, operating profit 2,640. Revenue 6,000. Multiply by 100.
37.7.
37.7. You have resolved.
So it's 44%.
Any question, please? Iruma figure 4. Current asset. The current ratio. Our current ratio is current assets divided by current liability. So go and pick your current asset now. Then pick your current liabilities. Divide it. Don't multiply by 100, please. Calculated in Our current assets, I can pick it from here now. Look at these two. My current assets. Current assets less cash and bank. I cannot take these two now. Look at my current assets. These two lines or these two rows. For Were 2020, total current asset 1,300 plus 1,000. What do you have? That's 2,300. Is that not?
Yeah.
Yes, sir.
For
Then we're
2019, 1,100 plus 900. That should be 2,000. For second is C. You have 2020, 1,500 plus 1,000. That's 2,500.
2,500.
Then for 2019, 1,690 plus 1,200. What do you have?
2,890.
2,890.
So we can check it now. 1,000, 2,300, 2,000. Look at it here. Then current liability, just pick it. Our current liability, 1,100, 900, 1,200, 1,150. You have it here. Please divide 2,300 divided by 1,100 and do same for other figures to get your current ratio. Please, let's compare. Let's move on. Yeah. Should not get tired though. Have you confirmed?
Yes, sir. They all correct.
They are all correct too. Next, quick ratio. We also call it asset sales ratio. The formula for quick ratio is quick ratio. The formula is current assets less inventory divided by current liability. Your current asset minus inventory divided by current liability. In this question, there's no inventory. Just pick the same thing you did for current ratio. It's also the same thing as your acid test ratio. Because in this question, there's no inventory. You have resolved A5.
So sorry, the profit margin ratio. The last one is 44%.
44.
Yes, the last one. Profit margin.
This.
Yes, sir.
How do you get 44?
Profit over sales now. That's 100 over 1.
Look at the profit here now.
2,640
Over.
divided by sales 6,000.
So what do you have?
I think the profit is 1,640.
This is the profit. So operating profit. Let's confirm it. So 640 divided by 6,000.
Okay, it's 1,640.
What is 1,640?
The profit, operating profit, instead of 2,640 is 1,640.
1,640.
Okay.
The operating profit.
And that will affect us here then.
Yes, sir.
And that should affect us here too. Let me check this. One, 640 divided by 744. Yeah, thank you, Dorcas. $1,000. Yeah. So this must change then.
Yes.
So it give us
22.04.
1,640 divided by capital employed 7,440.
22.0.
22.04.
That's 22%. So this will change. Oh, this is fine.
$27.3.
What do you say, please?
27.3. 27.3.
Okay, no problem. I will check. Divided by 6,000. 27.3. %. Okay. So I was trying to explain we are trying to explain acid test ratio. In this particular question, no inventory. So your current ratio is the same as your acid test ratio, or what we call quick ratio. So we have gotten up to 5. Number 6, Jerry. What is gearing ratio? Gearing ratio is the proportion of debt. When we say gearing, the extent to which a company has borrowed money. It's what we call gearing. So your gearing ratio is calculated as debt over equity. Or you can calculate as debt. When we say debt, we are referring to long-term debt over equity funds. Or you can calculate gearing as debt over total capital. Please note, total capital is long-term debt plus equity. I've given 2 positions. There are 2 ways to calculate your gearing ratio. I've tried to explain gearing. Gearing is the extent to which a company has borrowed money. To calculate your gearing ratio, you can use long-term debt divided by equity funds. Or you can use long-term debt divided by long-term debt plus equity funds multiplied by 100. Any of these can be used. You can now come to the question. And look at it. Long-term debt over capital employed. You can use this. Your capital employed is what we call debt plus equity. Your long-term debt plus equity. You can also calculate your capital employed as total assets less current liabilities. We are taking this pay because the next topic, we are still under divisional performance. It's white. When we are taking economic value added, this thing will come back to us. So look at it, please. Just copy your long-term debt figure. Divide it by your capital employed. Multiply by 100. Please, what do you have? Look at our long-term debt. Long-term debt is in the question, pick it. Your capital employed figure as computed, pick it. Now, check out this. 1,400 divided by 7,600 multiplied by 100. What do you have?
18.4.
18.4. Next.
20.8.
Next.
$80.1.
Then finally,
$14.8.
then the last aspect says interest cover ratio. What is interest cover ratio? How do we calculate interest cover ratio? Interest cover ratio, in case you are writing down, interest cover ratio is the number of times operating profit covers interest expense. Number of times operating profits covers interest expense. It is calculated as profit before interest and tax divided by the interest charges. Let this one go up. It's better this way. Operating profit divided by interest expense. The interest expense is given in the question. No? Look at it. So We just copy it. So divide 3,300 divided by 250. Please don't multiply by 100 though.
13.2.
13.2 times. Please, you have to put that times. Number of times company's operating profit covers interest expense. The higher the figure, the better for the company. Yes, for 2019, Owerri.
13.88 times.
Thank you. Go to the next center. Sekenesi.
$12.28 times.
The operating profit is supposed to be 3,970.
Don't mind this consistent copy from one side. But will it change the answer?
Yes, the answer is correct now.
15.888 is correct.
This should be 1,060 now.
No. 7.45. It's supposed to be 1,640, sir. The operating.
That's what I'm saying.
$7.45.
I will change it, don't worry. 7.45 times 7.45 times. You have gotten all the requirements sorted out for A. Look at the B. Compute the performance bonus of the centers, if any, and state your workings. Then briefly state the role of management accountants. That should be C part of the question. So the B part says we should calculate performance bonus of the center, if any. Now look at it. To qualify for performance bonus, the standard is, look at it, event center managers and their staff are rewarded with performance bonus of 10% of sales if they earn more than the approved standard return on capital, which is 50%. Performance bonus will be paid if a company can achieve above 50% return on capital employed. And that performance bonus is equal to 10% of the sales. Let's go check. Look at Owerri Center 2020. Are they qualified for performance bonus?
No, sir.
What about 2019?
No, sir.
Now look at Sekenesi Center. Would they be qualified for profit bonus?
Yes.
In 2020, Sekenisi Center is qualified for profit bonus. Now, what is this bonus? 10% of the sales. What is the sales for that event center in 2020?
10,000.
10 million. Please compute 10% of 10 million. That should give us 1 million, Abi.
Yes, or 1 million.
Or this explanation. Look at the bill. Actual performance, we pick this. This is 22.0. Qualify for bonus, not qualify, not qualify. Qualify. 10% bonus. Although this, you can read this, but we can also explain briefly. Return on capital employed, sometimes called return on investment, is the profit of the division as a percentage of capital employed. Sekenisi Event Center has a better return on capital employed than Owerri in 2020. They are comparing now. In 2020, Sekenisi, they achieved 55.1 compared to Owerri, they are getting 43.4. But in 2019, Owerri performed better than Sekenisi Center. Residual income is another way of appraising division performance, which shows absolute profits after deducting imputed costs or notional cost of capital for an operating profit. Sekenisi Center, Event Center, show better residual income. Let's check it. Let's compare. Residual income. Sekenisi has gotten 2,890, while this company has gotten 2,160. But in 2019, Owerri performed better than Sekenisi Center. Profit margin. This is the profit as percentage of sales. It shows profit achieved per 1 naira of sales. Let's go check which center is better. Operating profits. The Sekenisi Center is better than Owerri in 2020. But Owerri performed better in 2019. Liquidity ratio. The current ratio is the liquidity current asset and current liability. The ideal ratio is 2.1 or 2.0. This means that the company has enough liquid assets to meet the demand of short-term of current liabilities. Owerri Center have a better liquidity in 2020. Let's confirm that. Okay, marginally better now. Why Isekunisi is better in 2019? Quick ratio is a more effective liquidity ratio that shows relationship between current assets less inventory divided by current liability. In this situation, inventory is not specified. So we just adopt what we have in current ratio. Jerry. The Jerry ratio otherwise known as leverage ratio, shows relationship between long-term debt and capital employed. A company is said to be highly geared when its debt capital exceeds equity interest. And it is low geared where debt capital is lower than equity. Let's go check. These companies, they are lowly geared. 18, 20, 18. All the two centers are low geared, although in 2019 and 20, Owerri Center are slightly higher. Interest cover ratio. This measures the ability of the company to meet its obligation to pay interest. An interest cover ratio of 3 is considered low and shows that the company may be at risk from too much debt. Let's check the ratio. 13, 13, except for Isekunisi that you have 7. This is actually high. Isekunisi is better in 2020, but Owerri is better in 2019. You have explained. The last aspect of the question. What is the role of management accountant in project management? This question was taken from another topic. What's your role? If a company is to carry out a project management, what is the role of the accountant? Let's assume that your company is to deploy a new software. That's project now. Your company wants to deploy a new software. The IT team is to develop a new software. What is your role as a management accountant? One, understanding the economies of different options. You must ask yourself, if we implement this project, what will be the impact on company's revenue? That's the economics. As an accountant, our business is with the revenue, with the economic analysis. That's our business. If you are attending a project management as an accountant, what you are going to be asking them is, if we implement these projects, how does it translate to economic value for us? Number two, the accountant must be able to forecast cost and profits. What are the costs to be incurred in respect of the project? What are the revenue to be generated? You must be able to create accurate network analysis or Gantt charts. When we say network analysis, you are going to ask yourself, how does the new project interface with other companies' projects? You are not going to draw network analysis. We are trying to introduce a new project. Then you now ask yourself, what is the impact of this new project on the existing company's project? You can use spreadsheets for this. We do this in statistics. When you draw, that's what you do under decision tree. If you get to risk and uncertainty, you want will take you decision tree. We are going to have network analysis to show the path of the decision. Then you must consider external factors and other internal factors. This was the question last days. This was question number 6 last days. Look at second illustration. What is responsibility accounting? What is investment center? What is return on investment? Define residual income. This was last diet question number 7. You know, when I was trying to tell students that, go and look at PM question. What you say this question is hard. Is there any aspect within solving this class? If I ask you, What is, okay, let's answer. Please, what is responsibility accounting? Anybody? Yes?
Is the responsibility given to head of the account?
No. Oh, you are correct that responsibility given to head, but not head of account, please.
Okay, sir.
Responsibility accounting. This is where a specific individual or a manager is given a responsibility for a specific aspect of the company's business. Maybe in your office, you are responsible for monitoring the company's overhead cost. That your duty is to monitor all the overhead costs that the company incur, any cost that cannot be traced to a product, all the indirect costs. Or maybe in your office now, you are the head of, say, a particular division. Or how do I put it? Look at budget now. You are taking responsibility for a particular aspect of a company budget. Responsibility accounting. A specific individual or manager is made to take responsibility for a specific aspect of the company's budget. And that person will be responsible for that. You have your job function. That your job function, management can ask you questions about your job function. Like now, I take responsibility for PM. If the result is released now, they cannot ask me about FR. Management will now come here and you want. What is the performance of your students that wrote performance management? That means we are the responsibility accountant now. We are taking responsibility for that particular job. Look at it now. We have like 6 subjects in skill level. But for PM, responsible center, so responsible accounting. This is the structuring of performance report for individual manager in a way that identify factors that are controlled by them. What are the factors controlled by me? My own business is PM. At the management meeting, they will ask me about performance management. They will not ask me about FR. Is that clear, please? Is that
Yes,
clear,
sir.
please? Investment center.
Very clear, sir.
We also explain investment center. A division that takes responsibility for both the profits and the investments of the division. It is an operating division within an organization whose manager has the responsibility for both profits and investments. Investment center. Beyond the revenue and cost, the manager also takes responsibility for the investment. Return on investments. That is your return on capital employed, percentage of operating profits to capital employed, differences between operating profits and imputed interest charges. You know, there's a way student we had, you are saying this PM is hard. You have question 6. You have question 5. You have 30 marks to your advantage. Look at the B. Although I will stop here, I won't do it. Please go and look at the B. Ingige and Son. I want to put in Ingige and Sons Limited as for operating division, which are spread in different cities in Nigeria: Lagos, Kano, Gombe, Enugu. These divisions are treated as investment center for the performance reporting. The following information is available. Please look at it. Divisional investments, sales, variable cost, divisional variable cost, divisional fixed cost. The company's annual fixed cost of 1.3, which is apportioned to the division on the basis of sales. In addition to divisional fixed cost, we also have company's fixed cost. This company's fixed cost is to be apportioned on the basis of sales. The cost of capital for Ingige and Son is 7.5. Ignore tax. Evaluate the performance of the division using return on capital, return on investment. Then residual income. Please, what is return on investment? Your profits over total investment. Your profit, look at it too. The figures are available for us. Sales minus variable cost minus fixed cost. Then we are going to share this fixed cost to the 4 divisions using sales value. I can come here now. The only thing I need to do, look at my sales. Sales for the division, I'll pick. My variable cost for the division, I'll pick. Contribution, I will get it. The fixed cost, specific. The specific is divisional fixed cost. 1.5 million, 750, 600, 800. Pick. Then the general, that is the head office fixed cost. Let's apportion. This 1.3 million, you are going to apportion it on the basis of sales. What do we do? Add your sales together. Now prorate on the basis of sales. Please prorate. Our total sales is 130,000, a million. I can do for the first division 53,000. Please let me divide. 53,000 divided by 130,000. The answer you get, multiply by 1,300. What do you have, please? Lagos, 53,000. Total sales, 130,000. 53 over 130. Multiply by 1,300. What do you have, please?
530.
530. Look at it. 530 shared to Lagos. Next, Kano, 23,000 divided by 130,000. Multiply by 1,300. Look at it here. The head office fees cost to be shared on sales basis. What do you have, please? What do we have, please?
230.
30.
230. Go check Gombe. 24,600 divided by 130. The figure you get multiplied by 1,300. That will give you 246. Check Enugu.
Yeah.
29,400 divided by 130. Multiply by 1,300. That will give you 294. That's all. Contribution. Look at your total fees cost. Add these two together. 2,030. Add these two together. 980. Add these two together. 6,846. Add this together. Then you can get your profit. Contribution minus total fees cost. 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 You have your profits. Investment. Pick your investment figure. Look at the investment. Pick your figure. Three zero is up. This is 10,000. That is 10 million, 4 million, 3 million, 7 million. Return on investment. Profit over investment. Multiply by 100. 7.9. Profit over investment. Profit over investment. Multiply by 100. Return on investment for Lagos 7.9. Kano 5%. Gombe 11.8. Enugu 12.9. For the company as a whole, profits over total capital, over total investment, 9.37. You have resolved this. Residual income. I was like, oh, I'm sorry to say, last diet PM was a bonanza. I don't know that, maybe I'm wrong. That's one of the simplest PM I've ever seen. Residual income. Simply profit minus imputed charge. Cost of capital is 7.5. That is cost of capital multiplied by the investment. Calculate imputed charge. 7.5 of 10,000. 750. 7.5 of 4,300. 7.5 of 3,000. 255. 7.5 of 7,000. 525. What next? Less. What next? We are done. I'm just trying to, this we can do ourselves. Get your residual income, get your mark and move out. I would just like, the man that set that question was particular about divisional performance. Next is also in brackets. Look at the next question. Reevaluate residual income situation of the company, given that the cost of capital is 10%. They just change 10%. Remove 7.5 now. Make it 10%. Cost of capital 10%. Compute. 10% of investment. You have your figure. This will be in brackets. Less. Less. It doesn't work for us to come and start this one next week again. It's like wasting our time. Yes. Doesn't worth it. That's why I don't want to come back to this question. Do your deduction. No, this is wrong. 10% of 2,000. It should be 2,400 now. 2,400. Check out. Profit less imputed charges. You have your figures. All right. Yeah, you get it. I would tell the coordinator to reshare. Please, let's look at our material. Any question before we close down the class? Our next topic, we shall be looking at economic value added. Still under divisional performance. We shall look at economic value added. All right, thank you for your time. May God give us a better understanding.
Thank
Good
you,
night.
sir.
Amen.
Good night.
Amen. Good night, sir.
Good night.